Welcome back, everyone. I hope you're having a fantastic day, and thank you for joining me for today's detailed market breakdown. The data center and AI infrastructure space has been one of the fastest growing segments in the market. But even in strong long-term growth industries, individual stocks can experience significant pullbacks and volatility. That is exactly what we are seeing right now. While the broader data center narrative remains intact, certain names have been aggressively sold off. And today, we focused on trading APLD while also monitoring APLX for a structured swing opportunity. Earlier in the session, we saw strong volatility in APLX around the mid-60s range before sellers stepped in during the morning hours. There was clear downside pressure, and instead of reacting emotionally, we waited patiently for our predefined levels. Initially, we entered and exited quickly as momentum shifted, but we had already outlined a bearish entry trigger. If APLD approached the $28 region, we would consider stepping in with a controlled position. Over recent sessions, APLD declined from roughly 30 per share down to approximately $27.50, which is where it currently sits, and that is where we executed our planned entry. The information provided in this content is for educational and informational purposes only and should not be considered financial, investment, legal, or tax advice. I am not a licensed financial advisor, broker, or registered investment professional. All trading and investing involve risk, including the potential loss of principal. The stocks and strategies discussed, including APLD, APLX, or any other securities mentioned, are examples of personal opinions and market analysis and should not be interpreted as recommendations to buy, sell, or hold any financial instrument. Market conditions can change rapidly, and past performance does not guarantee future results. You should always conduct your own research, evaluate your financial situation, and consult with a qualified financial professional before making any investment decisions. By viewing or using this content, you acknowledge that you are solely responsible for your own investment choices and outcomes. Let's walk through the reasoning behind this trade and the structure supporting it. When dealing with data center companies, volatility is naturally elevated due to capital expenditure cycles, earning sensitivity, and broader AI sentiment. Because of that, risk management becomes the foundation of every trade. Looking at APLX specifically, the stock has been moving sideways after a strong prior run, and now it is pulling back into a key technical support zone. At first glance, buying into a declining price may seem risky, and yes, it is always possible that the stock continues trending lower. No setup is guaranteed. However, what we observed is that this support area has historically acted as a demand zone where buyers previously stepped in. Multiple prior pullbacks into similar levels resulted in bounces, making it a statistically relevant area to consider an entry. It is also important to acknowledge the broader market context. Following the most recent earnings from Nvidia, we saw heightened volatility across AI-related equities. Nvidia reported revenue growth and substantial profits, but expectations had been extremely high. Although earnings technically exceeded forecasts, the magnitude of the beat did not satisfy aggressive market sentiment, which triggered additional selling pressure. This reaction spilled into the broader AI and data center segment, causing many related stocks to trade lower. When sentiment shifts, correlations increase, and even fundamentally solid companies can decline temporarily. On the macro side, oil and petroleum stocks were among the few sectors trading green, reflecting strength in energy pricing. Rising oil prices often influence inflation expectations, and although recent CPI data has not been severely negative, the market remains sensitive to inflation trends and ongoing tariff discussions. Over the past year, tariffs have re-entered policy conversations multiple times, adding another layer of uncertainty to equities. When uncertainty increases, short-term traders reduce exposure, leading to rapid downside momentum in growth sectors like AI infrastructure. From a typical retail perspective, many traders repeat the rule, never buy in a downtrend. While trend-following strategies have merit, they are not the only profitable approach. Buying into weakness at strong support, with clearly defined risk parameters, can offer compelling reward-to-risk setups. it is absolutely possible that APLX fails to hold the $45 level, which corresponds roughly to 27.50 cents on APLD. If that support breaks decisively, continuation toward $24 on APLD or near $30 on APLX becomes technically plausible. Institutional selling, macro shifts, or further AI sentiment deterioration could accelerate that move. We recognize that risk, and we plan for it rather than ignore it. However, we also evaluate broader industry data. Despite short-term volatility, data center demand continues expanding. Margins across several infrastructure providers are improving as utilization increases and AI workloads scale. Not every company in the sector is performing equally well, but APLD has shown measurable revenue growth trends. Earlier analytical projections even suggested a potential move toward 26.50 cents, and the stock approached that level intraday before stabilizing above 27. While some short-term models indicate the possibility of continued bearish momentum toward $25, most medium-term projections lean moderately bullish over a one-month horizon. When aggregating multiple analytical perspectives, including technical trend models and infrastructure expansion data, upside bias begins to outweigh downside probability, provided support remains intact. Monitor include the 2650 region, which acts as near-term structural support. A sustained breakdown below that level would shift probability toward deeper retracement. Conversely, stabilization and higher lows above that zone would indicate demand absorption and potential reversal strength. This is why structured entries matter. We do not buy randomly. We buy at defined zones with predefined exits. In this trade, position sizing is equally important. The allocation was approximately $7,500, which keeps exposure measured relative to portfolio size. Our upside target for this swing sits in the 15% to 20% range. That implies a potential gain of roughly $1,000 to $2,000 if momentum resumes and resistance levels are reclaimed. The protective stop is placed slightly below the $44 level on APLX, aligning with the lower boundary of support. This limits downside risk to approximately 2 to 5% depending on execution. Maintaining a reward-to-risk ratio significantly greater than 1 is critical for sustainable account growth. Even if not every trade wins, positive expectancy over time drives performance. Psychology also plays a major role. When a stock declines 6%, 7%, or even 10% in a short window, fear escalates quickly. APLD has experienced nearly a 20% pullback from recent highs. Many investors respond to that fear by exiting at or near lows. Disciplined traders, however, evaluate whether the decline reflects structural damage or temporary sentiment shock. If the long-term thesis remains intact and support levels align technically, those fearful moments can present asymmetric opportunity. The goal is not to ignore risk, but to quantify it and act with intention. We also continue to monitor institutional flows, volume spikes, and broader AI ETF movements for confirmation. If downside volume expands significantly below support, we will respect the signal and exit accordingly. Flexibility is as important as conviction. Markets evolve and successful traders adapt rather than anchor to bias. Looking forward, if APLX begins forming higher lows and reclaims short-term moving averages, momentum could shift quickly. Breakout confirmation would strengthen the probability of reaching our 15 to 20% target zone. If that scenario unfolds, scaling out into strength may optimize realized gains while reducing exposure. Patience during consolidation is often required before expansion phases occur. Ultimately, today's strategy reflects 3 core principles. Enter at statistically relevant support, define risk clearly before execution, and maintain favorable reward-to-risk alignment. Volatility in the AI data center space is likely to continue, especially as macro headlines and earnings cycles influence sentiment. But volatility, when managed properly, creates opportunity rather than danger. That is the complete breakdown for today. We remain disciplined, data-driven, and risk-aware, while positioning for potential upside in APLD and APLX. If you found this in-depth analysis valuable, make sure to like the video, subscribe to the channel for more structured trading insights, and I will see you in the next one.